Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could in turn impact the positioning of our schemes. US yields closed flat during the month, March 2025, following a 33 basis points decline in February 2025. In contrast, Eurozone and UK yields increased by 33 basis points and 19 basis points respectively during the month, versus 5 basis points drop in February 2025. Japan yields continued to rise by 11 basis points, compared to 13 basis points rise in February 2025. The spread between US 10-year Treasury bond and Japan 10-year bond has compressed further in the month of March on account of higher Japan government bonds yields, while US Treasury yield has remained flat. US yields had risen intra-month on account of growing fiscal concerns and rising inflationary concerns. However, due to the increasing uncertainty of business confidence, the US growth printed sharply lower than the previous quarter. Yields fell from 4.36% back to 4.21% towards the end of the month. US on the growth front, US GDP quarter-on-quarter for quarter four calendar year 2024 printed sharply lower at 2.4%, compared to 3.1% for Q3 CY 2024. Manufacturing Purchasing Managers Index PMI also contracted to 49.8 in March 2025 from 52.7 in February 2025. However, due to the strong services PMI, composite PMI expanded to 53.5 in March 2025 from 51.6 in February 2025. On the inflation front, while CPI and core CPI printed at 2.8% and 3.1%, lower than expectations and January 2025 prints, expectations of inflation have increased. The Michigan one-year inflation expectations in March 2025 came at 5%, and the Michigan five-year inflation expectations in March 2025 spiked to 4.1% from 3.5% in February 2025. University of Michigan surveys consumers and presents the median expected price changes for the next 1/5 years. The result of the five-year inflation expectation remains the highest inflation expectation since March 1993. On a related note, according to CNBC's latest quarterly CFO Council survey, 60% of corporate chief financial officers expect a recession to hit the US in the second half of this year. A further 15% say a recession will occur in 2026. On inflation, 90% of CFOs say tariffs will cause resurgent inflation, and as CFOs worry more about prices, expectations for when the Fed can engineer it back down to 2% in keeping with its dual mandate keep getting pushed further out. Despite Fed Chair Jerome Powell himself holding out hopes that any tariffs inflation may be transitory, half of CFOs now say that the 2% target inflation rate will not be achieved until either the second half of 2026 or 2027. Japan. Yields in Japan continued to rise during the month, even though Bank of Japan maintained its policy rate at 0.5% this month. Salary negotiations between management and labor unions typically conclude around mid-March among major firms in Japan, setting a standard for the salary negotiations of non-unionized workers and smaller enterprises. Japanese firms agreed to an average wage increase of 5.46%, the second consecutive year for raises to exceed 5%, marking the highest pay hike in 33 years. This follows a 5.1% hike in 2024. On the growth front, gross domestic product annualized quarter-on-quarter growth for quarter four calendar year 2024 printed at 2.2% compared to 1.2% for quarter three calendar year 2024. The 10-year GSEC traded in a band of 6.58% to 6.74%, and closed at 6.58% in March 2025, vis-à-vis 6.72% in February 2025. sovereign yield curve bull flattened with short-term yields falling less than the longer-term yields. In addition to the expectations of further rate cuts, on account of slowing growth and cooling inflation in India, measures by Reserve Bank of India to infuse liquidity such as open market operations and long-term forex swap have pulled down G-Sec yields. At primary auctions, yields of 91-day T-bill hardened by 7 basis points, while 182-day T-bill and 364-day T-bill softened by approximately 8 basis points and approximately 7 basis points, respectively. CPI inflation moderated below 4.0% level to 3.61% for February 2025 from 4.26% for January 2025. The reading also came in lower than the Bloomberg's median poll of 3.98%. A sharp sequential decline of 47 basis points, along with a favorable base of approximately 16 basis points, led the year-on-year reading to decline from 4.26% in January 2025 to 3.61% in February 2025. Food and beverages inflation moderated to 3.84% in February 2025, lowest since May 2023. Vegetables noted a deflation of 1.07% in February 2025 on a year-on-year basis, led by a sharp decline in prices of tomato, garlic, ginger, cauliflower, etc. Along with vegetables, pulses also noted a deflation of 0.35% in February 2025. Core inflation slightly increased to 3.95% in February 2025 from 3.67% in January 2025, largely led by a sharp increase in prices of gold and silver. Inflation scenario has improved in the past few months, aided by a sharp decline in food prices. As inflation is expected to remain closer to the target of 4.0% in fiscal year 2026, it is likely that the RBI would continue with monetary policy easing. During the month, dollar index depreciated by 3.11% as growth concerns linger in the US. Also, strong euro appreciation following the announcement of hefty fiscal stimulus also put dollar index under pressure. Indian rupee portrayed revived strength in March 2025 and appreciated by 2.16%. Indian rupee traded in the range of rupees 85.46 to 87.36 per US dollar during the month and ended the month at rupees 85.46 per US dollar, strongest since December 2024. Liquidity conditions during March 2025 continued to remain tight. However, systemic liquidity by end of March 2025 turned into a marginal surplus, aided by RBI's continued pro-liquidity measures and increased government spending towards the end of the month. In March 2025, RBI infused liquidity to the tune of approximately rupees 2.3 lakh crore through open market operations purchases and US dollar Indian rupee buy-sell swap. Banking system noted a daily average deficit of rupees 1,46,991 crore in March 2025, compared to a daily average deficit of rupees 1,66,658 crore in February 2025. Going forward, liquidity conditions could remain comfortable, aided by RBI's easy monetary policy and continued liquidity supportive measures. US growth has shown some signs of weakness. On a month-on-month basis, retail sales have grown by only 0.2% in February 2025 versus 0.6% expected, following a contraction in January 2025 of 1.2%. Federal Open Market Committee maintained status quo on its policy rate in March 2025, highlighting both the risks of economic growth and inflation. Chair Jerome Powell has indicated readiness to take policy decisions on either side. With some moderation in growth expected and upside risks to inflation, Federal Reserve has revised down the growth projections and revised up the inflation projections for 2025 and 2026. The Trump administration is broadly focusing on trade, immigration, fiscal policy, and regulation. A more protectionist approach with him imposing higher import tariffs, a strong stance on illegal immigration, and an attempt to cut down fiscal deficit could impact growth adversely and potentially derail the disinflation process. The effects of Trump's tariff measures need to be monitored closely. The effect on inflation in the short term, the medium-term growth outlook will directly impact global yields and their respective currencies. The bulls driving U.S. yields down, faltering growth and flight to safe haven assets, are likely to be restricted going ahead as concerns about inflation and fiscal policy may keep U.S. yields elevated. U.S. dollar is likely to remain strong as the rate divergence is expected to widen, except Japan. China's sluggish economy is expected to have support both from monetary and fiscal side to get its economy back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. Brent oil prices have started to increase due to the widening of the ongoing geopolitical conflicts and reduction in output by Brazil, Russia, India, China, and South Africa. Similarly, commodity prices have also inched up during the month. However, developments related to U.S. tariffs on China need to be monitored and its impact on the global economy. Japan, on the other hand, is on a rate hike journey, and the continuing unwinding of yen carry trades have affected yields adversely. Given the growth focus by both the government, fiscal support through income tax cuts, and Monetary Policy Committee, monetary support started with a repo rate cut of 25 basis points in the last policy. A further rate cut of 25 basis points is widely expected in the upcoming Monetary Policy Committee meeting in early April. Further, Consumer Price Index moderated to below 4%, aided by a decline in food prices. RBI has also shown consistent support to the economy through ample liquidity measures in the month of March 2025. Such support from RBI is expected to continue as and when required. FY 2025-26 Union Budget had announced a borrowing of 14.82 lakh crore rupees, which was slightly higher than the 14.01 lakh crore rupees in FY 2024-25. The RBI announced the borrowing calendar for the first half of FY 2025-26. The total amount to be borrowed is 8 lakh crore rupees, indicating 54% of the total borrowing requirement. The markets had expected an increase in borrowings in the belly of the curve, and the borrowing schedule has increased borrowings in the 10-year segment from 1.80 lakh crore rupees in H1 FY 2024 to 25 to 2.10 lakh crore rupees in H1 FY 2025-26. Factors that bode well for the domestic bond market include inflation being in line with the target, growth which is resilient though moderating, and a rate cut widely expected at the next policy. Thus, we maintain a bullish bias on the sovereign yield curve and the corporate bond curve and expect the domestic yields to move lower. Further, while the corporate bond curve is currently inverted, we expect it to normalize over time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.